Hi everyone, welcome back to the US CPA classes for regulation exam. This video is in continuation with the earlier video of cost recovery. Here in this video, we'll be covering the remaining two topics, that is depletion and amortization, right? So federal taxation of property transaction, the topic we are covering in cost recovery, that is depletion and the amortization. So let's dive into to understand more in detail from the US tax perspective about depletion and amortization.
Hi everyone, welcome back after the break. So before we went on a break, we have started with the topic of cost recovery. In that, like I said, we'll be discussing three things: depreciation, depletion, and amortization. So we have already started with depreciation, section 168. So where we discussed like the definition as well as on what asset depreciation is to be levied. And then after we were at the depreciation method, which is 𝐂𝐻, which is most preferred method, and the second method is alternative depreciation method, which we will be discussing once we complete the 𝐂𝐻. Here we discuss about like full cost, life of assets, and usability of 𝐂𝐻 or exception from 𝐂𝐻 on intangible and property, that is on that depreciation is being charged on based on the number of unit produced. Then after we started like real estate, or I would say real property, right? In the real estate, there are two type of property: residential property and business property, or I would say non-residential property. Non-residential property includes dams, roads, bridges, building, construction site, right? So everything which is other than residential purposes, right? So the life is being defined in IRC 27.5 year and 39 year, which we have discussed. And then we discuss about mid-month convention method used for real property. So here, mark this word: mid-month convention method is used only for real property, not for personal property. Now we are jumping onto the personal property. So in the personal property, there are like few age brackets, or I would say life bracket for the respective category of assets, right? So the 3-year period, 5-year period, 7-year period, 10-year period, most of them, for when we are using the written down value method, we use 200% declining method. If we are using straight line method, which is alternative depreciation method, so then we will not be using it. On the other hand, the assets which is like more than 15 years, 15 year, 20 year, or more than that, for them we can use 150 declining balance method. But when we are using alternative balance method, then it will be just a straight line method of depreciation. So taxpayer may elect the depreciation method class by class. So these are like classes which is being defined: 3-year, 5-year, 7-year, 10-year, 15-year, or 20-year. So accordingly, you need to choose the respective life of the assets from the respective class of asset. Most common use assets for 3-year bracket. So these are like 3-year and 7-year is like most commonly tested in the CPA examination. So the assets which come under the 3-year bracket include automobile assets, which is your car, trucks, right? Then general purpose light truck, computers, and office machinery like typewriter, printer, copier. So they all come under the bracket of 5-year assets. 7-year assets include heavy or special purpose truck, office furniture, and fiction. So why we have mentioned this specifically? But most of the time, because most of the time in exam, we have seen 5-year or 7-year category of assets being tested. When you are using, when you need to calculate the depreciation on personal property, right? So there are two methods available. The first is half-year convention method, and the second is mid-quarter convention method. The first is half-year convention method. Generally, 1/2 of the year recovery deduction is taken for first year of the use, regardless of the month the property was placed in service. That means if you have elected or if you have chosen to be half-year convention method, same way like election of depreciation policy is in the hand of management. So if the management has chosen half-year convention method for personal property, then during the year, whether on 1st January or 31st December, whatever the number of asset the company has purchased, on total half-year depreciation is allowed, right? Second is mid-quarter convention method. Mid-quarter convention method says whatever the assets you have purchased during the quarter, right? Q1 is Jan, Feb, March, Q2 is April, May, June, Q3 is July, August, September, and Q4 is October, November, and December, right? So what they are saying, at any point of time during the quarter, you have purchased any asset. For that particular quarter, when you have purchased the asset, you will be depreciating for 1.5 months, which is half quarter. Make sense? Any doubt here on half quarter or mid quarter? For example, you have purchased certain asset in Q1, which is January, February, and March, right? So to all those assets which you have purchased in Jan, Feb, and March, you will be charging 1.5 month depreciation for Q1 plus remaining 9 month full depreciation. So your depreciation for the year of purchase will be for 10.5 month, 9 full month, which is starting from 1st April to 31st December, plus 1.5 month of Q1. Same way, if you have purchased the assets in Q2, let's assume you purchase certain assets in April or May, right? In that case of scenario, for Q2, half of the quarter depreciation will be charged. That is 1.5 month of Q2 only on the new assets purchased in Q2, right? If there is any assets purchased before that, for them it will be full depreciation, but for new assets purchased, it will be 1.5 month of Q2 plus the remaining 6 months. So the total depreciation for the asset which you will be purchasing or your client will be purchasing in Q2, you will be charging a depreciation of 7.5 months. Same way for Q3 and Q4, it will keep on down.
So
Right?
they can follow either of these, right? Or
Yes. So for real property, there is only one method, which is mid-month convention. But for personal property, there are two methods. Taxpayer can choose any of that, right? If the taxpayer has chosen half-year convention method, then it is generally more simple. Whatever the assets you have purchased during the year, for that you provide 6 month straightforward depreciation. Second option, the taxpayer can choose to be mid-quarter convention. So in that case of scenario, in the quarter, whatever the asset is purchased, for that particular quarter, half quarter depreciation is allowed, even though it is being starting from day 0. Clear?
so it totally depends on tax planning, if
Yes,
they'll choose
absolutely.
your, yeah.
Absolutely. Like for example, but yeah, whatever the method you are using has to be consistently applied. So that is the thumb rule for any law on the earth. Like if you're choosing any particular method, then you need to make sure that method is consistently applied. For example, like initial for first year, you have purchased most of the assets in December, right? Then in that year, if you wanted to charge more depreciation, you can go for half-year convention method, right?
Right.
And you can charge depreciation for 6 months, and those depreciation will result into net operating loss, and net operating loss can be carried forward infinitely. right? On the other hand, you can choose for mid-quarter convention method if you wanted to use the depreciation in the remaining period over period mode, right? So yes, it has been part of the tax planning. It does not have any tax evasion,
Okay.
right?
The consistency is in context to asset or in context to SSE or
In
finance?
context to the method which taxpayer is using. If you are using in 1
For
year
all the assets.
for the for the respective category of asset, right?
So we
For
can
the
change the category and the method.
no, you cannot change the category. Category is being defined by IRC, right? For 3 year, it will be laptop, mobiles, accessory. For 5 year, we have seen like automobiles, trucks, cars, computers, office machinery, typewriter, printer, right? So those are being defined there.
No, my question was whether I can change the method for each category in each year, or I need to means I need to maintain consistency for the this for all the assets.
Yeah, very good point. So, for the respective method, for example, for real property, you are using a mid-month convention method, right? And that you are using consistently. Whereas for personal property, let's assume for electronic item, you are using mid-quarter convention, right? For plant and machinery, you are using half-year convention. That is what you are saying? Hope I
Yes, sir.
understand,
Yes, sir.
right?
Yes,
And
sir.
then
Yes.
for the respective category, you need to follow the respective method consistently. It should not be in year 1, you are using half year, and year 2, you have switched to mid quarter. So, whatever the method you are planning to use, that has to be applied consistently.
Got it. Thank you.
Hmm. Next is disposal of personal property. So generally, 1.5 year cost recovery is allowed in the year of disposition or retirement or similar to acquisition. If mid-quarter convention applies, the cost recovery will be in a range of 1.5 months to 10.5 months, as we have discussed above, right? So in the month of sale, also in the period of sale, if you are using half year convention, then half year depreciation will be used. If you are using mid-quarter convention, then 1.5 months of that particular quarter in which the asset has been sold will be used. Same way. Next is section 179. This is for additional depreciation basically. So it applies to other than estate, trust, or certain non-corporate lessor. So this is additional depreciation. Section 179 is actually additional depreciation which is not applicable to the estate, trust, or certain non-corporate lessor. Other than that, Section 179 is applicable. Section 179 applies to all tangible asset. It does not include intangible asset, such as machineries and equipments, new or used both. That means if you have purchased any old machinery in current year, then also you can use additional depreciation. So the concept of additional depreciation or bonus depreciation, what it is, right? So first let's understand, then probably when we jump into the theory, we all can comfortably correlate. Why any government will give additional depreciation or bonus depreciation to any company? When government want these private player to come at the respective place, right, and do their investment. To attract the investment, these are tax benefit that government do provide to the taxpayer, right? In the US, there are almost 50 states. Out of those 50 states, only the few states are being considered as developed. Maybe like California, maybe like New York, New Jersey, couple of states. But there are so many states, right, which are not yet developed in United States of America. Same way how in India, for developing any state, we create special economic zone, SEZ, right? In US also, these kind of additional benefit provide to those corporation, right? If you see, like in recent 5 to 6 years, there is a new gift city has been established in Ahmedabad or Gujarat. Have you heard about that? Any of you have heard about the gift city?
Yes, sir.
Right. So what is that gift city? If you have some idea, if you like to share something.
Gift city is a one type of uh, so I can see I see gift city, but I cannot elaborate.
Yeah. So just for the benefit of everyone, what the government of India has done, they have created a gift city as a tax haven, right? Where like foreign investor can come and invest money, and they can comfortably repatriate their money as a dividend by earning over here, right, without paying additional taxes. In addition to that, the people who are making investment over there, government is giving lot of tax benefit, both GST benefit as well as federal government or central government tax benefit, right? So the central government tax benefit include additional depreciation and the bonus depreciation as well. So in that, government says, if you want to make investment over here, so whatever you will be investing on plant, machinery, equipment, right? So 100% of that will give you as additional depreciation if you meet certain condition, right? 100% of that or 50% of that will give you will give you bonus depreciation. But for that, you have to meet certain condition which is being required by the government, right? So this give additional opportunity for the investor to pay less and less taxes in that particular place, and that make the return on investment higher, and that drive for the investment from the investor point of view. Make sense? What is investor looking for is the return on investment. If the return on investment is good, then many investors are being ready to make the investment. If you will not make return of investment good, then it will be very difficult for any city or any state to generate capital. Make sense?
Yeah.
Now coming back to section 179, which is additional depreciation. So here, like government is providing additional depreciation if you make investment in specific state for the development of that state, right? And if you make capital expenditure for the setting up new office, setting up new construction house, setting up new warehouse, setting up new business, right? So on and so forth. So section 179 applies to tangible personal property such as machinery, equipment, new or used both, or certain qualified real property used for trade or business. 179, taxpayer immediately deduct capital expenditure as business expense. That means, for example, you have made $1 million of investment, right? So the government is saying you can charge this entire $1 million as your expense in current year. On top of that, you still have your assets in your books for which you can charge your normal depreciation. So the expense which is being allowed actually help the normal or routine or the people who are earning less income, because for them it is almost exempt income, or for them it result into very tax payable, very low tax payable, because they get entire expense, entire amount as depreciable expense, as an additional depreciation expense in the same year. Second thing is that you can, like if you see the this depreciation claim will result into a business loss, right? And that business loss can be carried forward infinitely. So that is the additional benefit that organization get for making investment at such places. So if you are making investment in such places like Gift City we have in India, so there are a couple of benefits. First is they can charge the entire amount as depreciation. So that may result into significant reduction of their tax liability, or it can be the tax credit for future year. Right? So makes sense. For 2023, the maximum limit is $1,160,000 for individual assets, or for the group of assets, it's $2.89 million. These amounts are indexed for inflation every year, an aggregate of all assets eligible for deduction, right? And it includes both new assets as well as used assets which you have purchased. Any doubt on section 179?
So just one question.
Mhm.
This section 179 applies for international investors or local investors as well?
Say that again, your voice is not clear. International?
Uh, like the example you've given for investing in a gift city,
Hmm.
this advantage is only given for foreign investors or a local
No,
investor also?
both. So it is on investment base, whether it's like foreign investor or local investor. Right? State government want like people, the businesses should come and invest in their state so that their economic will grow. So these are the incentive that any government provide generally. Right? Next is qualified real property. Include the cost of roofing, heating, ventilation, air conditioned property, fire protection, alarm system, and security system. Or next topic, similar to additional depreciation, is bonus depreciation. Right? I know in India there is section 32B, which is similar to this as a bonus depreciation. Any idea? Any of you have any idea about bonus depreciation? What is that? For example, if you have invested in any asset, let's assume $1 million, right? And the life of asset is, let's assume, 10 years. And you are using the straight line method of depreciation. So that means $100,000 of depreciation you will be charging over the period of 10 years, right? Yes, no.
Yes, sir.
Right? But what the government is saying, for making investment in such a state where investment is required, will give you bonus depreciation. Bonus depreciation are most of the time in year one only. What they are saying, you can take bonus depreciation of 20,000 additional over and above to the normal depreciation in the year of investment. So in the year of investment, right, the bonus depreciation for 2018 to 22 was 100%. For 23, which is current tax year we are using, for that it is 80%. Next year it is going to reduce to 60%, then 40%, then 20%, and after that it will be nil. Right? So what they are saying, the bonus depreciation you can charge, which is over and above the normal depreciation in year one when you are purchasing the asset up to the limits which is being shared with you for the respective financial year. Make sense?
Yes.
Okay, let's do a question together. Dr. J purchased an apartment building as an investment in 2023 and the property is available to rent. The apartment are fully furnished. Which of the following statement is correct? He can elect to deduct as section 179 deduction up to $500,000 of the portion of cost allocable to furnishing and depreciate the remaining amount. Second is, he can depreciate the purchase price of apartment building. So he can depreciate the total purchase price of apartment building. Third is he can elect to deduct as section 179 deduction the purchase price of apartment building. And the last one is he must capitalize the purchase price of the apartment building. So what is the call of the question? Which of the following statement is correct? Out of these four statements, which statement sounds correct? First is he can elect to deduct 179 deduction up to $500,000. Have we read any such limit so far?
No.
So first is incorrect. Second, he can depreciate the purchase price of the apartment building. Can he depreciate the entire purchase price? The answer is no, right?
No.
So there may be, like he is owning one apartment. There may be other apartment in the building also. So you should not be considering that. Third is he can elect to deduct as section 179 deduction, which is the purchase price of apartment building. So answer is yes. Fourth
No,
is, sorry,
sir, how can we don't see condition of investment in a special area where he can use the section 179 deduction? This is not given in the question.
okay. So no worries. Let's go through again. So first thing is J purchased an apartment building as an investment in 2023 and the property is available to rent. So property is available to rent, that is used for trade and businesses. The apartment is fully furnished. Which of the following statement is correct? First we have discussed. Second is he can depreciate the purchase price of apartment building. Third is he can elect to deduct section 179 deduction. Yeah, so there is no information provided that section 179 is applicable to this property because it is not an investment on plant machinery or in special economic zone where additional depreciation is being considered. And the purchase price of the apartment building. Yes, you are right. So third option will not be considered. Fourth option is he must capitalize the purchase price of apartment building. So the capitalization is, I think, already done when he has purchased. So now the capitalization is not required, but the depreciation is required. So if you see the second option, he can depreciate the purchase price of apartment building.
Is only
Make
correct
sense?
thing, right?
Right?
Yes, sir.
Yeah. So in entire question, there is nothing mentioned about additional depreciation initiation. So far, we have covered modified accelerated cost recovery system, which is MECAR. Now we are coming to the second leg of depreciation, which is alternative depreciation system. It is similar to straight line method of depreciation, but the nomenclature you'll be seeing is called alternative minimum depreciation. Sorry, alternative depreciation system, right? So alternative depreciation system is used to calculate the depreciation of property used predominantly outside the United States of America. So when you have assets outside United States of America, then most preferably you will be using alternative depreciation system. Lease property or used for tax exempt entity. So if you are using the property for lease purpose, then also alternative depreciation system will be used. Finance with the proceeds from tax exempt bond. If you have purchased any asset from the tax exempt bond which you have sold, right, then that assets should not be considered as a for assets for the alternative depreciation method. Rather, it should go for MECAR. Next is import from countries engaged in discriminatory practice. If you are purchasing any asset from the country which is being into discriminatory practices, then to that country asset you will not be charging MECAR, rather you will be using alternative depreciation system. Next is listed property used 50% or less in the qualified business. So for example, like let's assume you have car. That car you are using for personal purpose as well as you are using for business purpose, right? To claim the depreciation of that car, what you do, you transfer that car to the business purpose and you use it entirely for business purpose, right? So in that case of scenario, you can elect for alternative depreciation system. But if 50%, 30%, 20% or 15% of that car you are using for personal purpose, right, and partly you are using for business purpose, in that case of scenario this method is not applicable. You will be charging depreciation on a MECAR basis, not alternative depreciation basis. Last one is certain farming equipment. Farming equipments have are being used generally the alternative method of depreciation because it is simple and very straightforward, right? Generally, depreciation under the method is calculated using straight line method without regarding of salvage value. So normally, alternate minimum depreciation method is using straight line method of depreciation except MECAR, right? Depreciation of personal property for alternative maximum tax is calculated by using 150% declining balance depreciation. Switch to straight line method when appropriate to maximize the deduction. Government published table the automatically provide for each of the special convention that a taxpayer may use for the year of acquisition for both real and personal property. So bonus depreciation. Every year when the finance bill come, the government do publish about the changes in this amount. And these amount are subject to changes of inflation index, right? Special rule for automobile cars, trucks and SUVs specifically. So like we were discussing one example, if you have a car which 50% you use for business purpose and the 50% you use for personal purpose, right? In that case of scenario, what you should be doing? Additional depreciation limitation, business use less than 50% or business use more than 50%. So these are the two scenario arises. Business use for less than 50% do not qualify for regular depreciation, bonus or section 179 first year expenses. So if business use is less than 50%, then no additional depreciation or no bonus depreciation is allowed. Whereas if you are using personal asset for more than 50% as a business asset, in that case of scenario, 40% of that business is allowed, right? For that, additional depreciation and bonus depreciation is allowed. So available regular MECAR and section 179 depreciation, immediate capital expense claim can be made. Left hand side, if you see, it must be depreciated under alternative depreciation system. If your asset which you are transferring to the business is used less than 50% for a business purpose, then from that particular year onward, right, mark this word, that particular year onward, the depreciation will be charged on alternative depreciation method, right, but not under the MECAR. Right hand side, if you see, If further business usage drop below 50%, a permanent switch to SLM is required. And if in the earlier year you have charged additional depreciation or bonus depreciation, that you need to recapture, right? So the recapture of depreciation is also here. Additional limitation for luxury automobile. But before I jump onto the additional depreciation, have you understood the concept for automobile special rule? 50% or less business purpose use or 50% or more business purpose use. Have you understood both the concept? Or do you want to explain me something specific? So far, so good? Yes, no, are you guys here with me? We already took 20-minute breaks.
The
Yeah.
only thing is how is going to track
That same as fixed
whether
asset
it is being.
register, right? Every company do make their fixed asset register, right? So on the fixed
No, no,
asset,
use whether a
use.
person is.
Yes, yes, yes. So that will go with the declaration basically.
Okay.
Yeah, you are right. So yeah, it's a gray area. Very true. Very right.
Yeah.
It's a gray area, but like you need to take that declaration from the respective person who is using it, right?
Okay.
So next is additional limitation for luxury automobile. Luxury automobile like Rolls Royce, or I would say Bentley, such kind of Jaguar, such kind of
And
high-end
that is
car.
also, sir, for United States. That is also a normal users car now.
Sorry, I didn't
Business houses are
understand your
using.
question.
So in US, normal businesses are using these luxuries, even though they are luxuries. But for business, they are normally using these cars. So how to define a luxury? Is it a dollar specification?
Yes, yes, yes. So we'll come to that. What all comes under the luxury automobile car? Yes. So your question is, I hope I understand correctly, or what I understand, I'll share that. You are saying most of the businesses owner they use luxury car, right? How to identify
Yes, sir.
whether that car is luxury to apply for this depreciation limitation, right? I hope I
Yeah.
understand your question correct.
Yes, yes, sir. We
Yeah.
used some taxis over there. They were like limos, but
Yeah.
the people were they have having a one or two cars and they are using it on the taxi services. So how
Yeah.
they will define whether it's a luxury or not? They are using a
Hmm.
business.
Yes, yes. So yeah, limos are luxury. Very true. And like this Lamborghini or maybe Bentley or maybe Rolls Royce, they all come under the luxury category. So there's a definition. We'll be discussing that also. Additional limitation for luxury automobile. A dollar limit for depreciation is mandated for each car in use for the tax year beginning after 2017. So this comes under TCJ Act. These limitations will be adjusted for inflation using automobile component of consumer price index. So that means they come up with some depreciation limit for the respective category of car, but every year it keep on changing based on the impact of inflation, right? Now, one second. So the maximum depreciation for year one, you can charge is $20,200. Year two, $19,500. Year three, $11,700. And year four, and then after $6,960 at 100% capacity use, and reduce the proportionate if used less than 100% capacity for business purpose, right? So these are the maximum depreciation on those luxury car. Following automobile are not subject to luxury automobile car. Trucks, SUV, vans weight over 6,000 pounds, normal automobiles, taxi, and limousine. So limousine is being, if it is being used for taxi purpose, then it is not part of luxury automobile. If it is for the personal purpose, yes, it is luxury car. Right? So exam tips here. The personal property, which is furniture, computer, machinery, equipment, you need to use half-year convention method or mid-quarter convention method. For personal real property, only the mid-month convention method is allowed. Right? That we have discussed before the break. Now, recovering the cost of leasehold improvement. Right? So what is leasehold improvement?
So the last question.
Mhm.
We have not discussed so far block of asset concept.
Mhm.
Like in bookkeeping, people use a block of asset. Like all the
Mhm.
computer equipments will be under computers, all the
Uh-huh.
cars into.
Mhm.
So in that case, how we will be keeping the record of uh, purchase year and how we will be charging the depreciation based on
Mhm.
half yearly or mid quarter convention,
Mhm. Yeah,
because
yeah.
that will be new car edition and old one replaced out.
Mhm.
So for tax purpose, we need to make a
Mhm.
schedule for all those things and then
Yes,
apply.
yes. So, the block of asset concept, which you call it in India, in US, they call it life, based on like classes based on life. So life is being defined 3 year, 5 year, 7 year, 10 year, 15 year, or 20 year. So there are two type of assets: real assets and personal asset. Real asset is being further classified into two categories: residential and non-residential. For residential, the life is 27.5 year. For non-residential, 39 year. Right? So accordingly, you need to charge the depreciation. For personal property, there are these six categories of, you can say, the classes of asset, right? So here we have discussed like most common categories being used or tested in the examination is 5 year and 7 year. 5 year
Okay.
assets include like your automobile, trucks, computers, office machinery, printer, typewriter, those things. 7 year are majorly like heavy vehicles, trucks, furniture, fixtures, offices, furniture, fixture, those things, right? So the classes are there for 3 year, 5 year, 7 year, 10 year, 15 year category. Make
It is
sense?
quite simpler than the Indian's chartered account.
Yeah.
Yeah.
Earlier in India also it was simple, but I think after Companies Act 2013 it has changed a lot, right? Clear, Prakash? Hope this answers your question.
Yes, sir.
Yes.
Yes, sir.
1 second. 33 more minutes. After that, you can take bobs. Okay, recovering the cost of leasehold improvement. What is leasehold improvement?
If we bought any place
Improvements
on
on property
leased
taken on rent or
apartments,
lease.
If we have taken,
Property on lease or rent, and you are
yes,
making changes for your business requirements.
yeah. So there are two type of leasehold improvement. One is you have taken a piece of property on lease, right, which is generally a long-term lease. And 1 second, guys, don't do this, otherwise other people feel sleepy. Right. So one thing is that you have made infrastructure changes based on your business need, and that infrastructure you'll be using for more than 1 year. So that is called leasehold improvement. Now, this leasehold improvement could be you have done over and above the rent, right? Or second, it could be possible that it add a value to the tenant or to the landlord who has provided you the piece on a rental basis, right? And as you are doing those leasehold improvement, he or she is reducing some amount of rent, right? For example, in showroom, right? In a mall, let's assume in a mall, I have a shop, right? But that is completely a bare shop, right? And if I have to make it, like basic shops, so I need to make some infrastructural upgradation. Like for example, when you purchase any shop in the mall, normally they'll give you complete bare shop, right? So that anyone who can purchase that particular shop or come on a rent, you might have to invest some money for like tiling, electrical fittings, AC, like all those things. You might have to make certain infrastructure changes, right? So for example, you have purchased a shop in a mall for, let's assume, $100,000, right? And if you make all the basic infrastructural changes which is required for anyone to come to buy that property or to take on a lease, you need to invest, let's assume, $25,000, right? But someone come to you and he or she say, I'll make all these infrastructural changes, but I request you to charge me depreciation instead of $2,000, $1,500 a month for a period of 5 years, right? So that means it is in lieu of rent. Yes or no? The leasehold
So
improve.
in
Mhm.
so where in simple terms, it depends on the contract.
Yes, yes, yes.
Whether you are getting only the four wall covering area,
Mhm.
or including the infrastructure fully furnished, and then you are
Mhm.
paying rent. So if
Yeah,
you are
yes,
paying rent only, then you can take it as an expense. But
yes,
if you are making changes, you can capitalize it and you can use it as a
yes.
depreciation.
Yes, yes. If something you are making in lieu of rent, that is reducing your month on month rent, it is being considered as rent expense. But something, if you are making it for the leasehold improvement, for that you can charge amortization cost, right? So left hand side is made in lieu of rent. So that amount you need to deduct as rent expense in lease tax and included in the income of lessor for tax purposes. If you have not made the leasehold improvement in lieu of rent, that is, you made it for your requirement, then you can capitalize and recover it by using MECAR. Right? Clear, everyone?
Yes, sir.
So we are done with depreciation topic. So the next topic is amortization. Amortization is on what?
Intangible assets.
Intangible asset. So first, look at the definition. Amortization of intangible asset is a process. Amortization of amortization of intangible asset is a process by which the cost of such asset is incrementally expensed or written off over the time. Amortization apply to intangible assets, while depreciation apply to tangible assets, and intangible assets include software, patent, copyright, trademark, goodwill, all these things. So it's a basic definition of intangible on which amortization is being used. Recovering the cost of intangible assets. So there are two parts to it. First is, if for that intangible useful life is less than 15 years, then you need to amortize for the useful life, right? If the useful life is more than 15 years, then maximum you can amortize up to 15 years. I think like when we started depreciation, one of you have asked, shared an example for software, right? So if the life of software is like less than 10 years, less than 15 years, or let's assume the life of software is 10 years. So then you will be amortizing the software over the period of 10 years. If you expect the life of software is 20 years, then you will be amortizing in 15 years. So maximum life for the tax purpose is considered 15 years. Make sense?
Yes, sir.
Right? So interest in land, financial interest, software, mortgage services, and leases of tangible personal property are excluded from definition of 197, which is intangible. Research and experimental expenditure may be expense paid or incurred during the year. Capitalization and amortization over the period not less than 60 months, or capitalization or amortization ratable over 10 years, and they avoid alternative minimum tax consideration, as this will not more a tax preference for AMT purpose. So these things you need to keep in mind: interest in land, financial interest, softwares, mortgage services, and the leases of tangible personal property are not covered in section 197. So that will go under MECAR, normal depreciation. But other properties can be used, like goodwill, which we were discussing earlier. Goodwill, patents, copyright, trademark, right? Those are intangible. So once again, there's a confusion on software. So once again, I'm just highlighting this. So maybe like in next class, I'll get back to you why there is software. So software either should be included or should be excluded. This point you can just highlight in your notes. I'll get back to you in next class why it is at both the places, right? So this is about intangible assets, and very simple, like if the life of the intangible asset is more than 15 years, you'll be amortizing over 15 years. If the life of asset is less than 15 years, you're amortizing over the life of the intangible asset. And amortization is straight line basis, right? There is no WDV or there is no MECAR as such, right? So let's do a quick question over here. Jamie owns a duplex. He lives in one half and rent out the other half at a fair rental value. He wants to take depreciation on the building and appliances and major remodeling in bathroom of his rental site. What depreciation may be taken? So the call of the question is, Jamie has a house, and in that house, let's assume there are two rooms attached, like washroom and other things. So one room he is staying and one room he has given on rent, right? So he lives in one half and rent out the other half at the fair rental value. Now he wants to take depreciation on the building, appliances, and major remodeling expenses which he has incurred for setting up the bathroom for rental site. So what depreciation may be taken? First one is 27.5 year MECAR on both sides of the duplex, and 5-year MECAR on the appliances and remodeling. Second is 27.5 year MECAR on both sides of the duplex and 7-year on the appliance remodeling. Third is 27.5 year of MECAR on the rental property and remodeling, 5-year MECAR on appliances on depreciation on personal side. Fourth is 27.5 year of MECAR on rental side and 0 on personal side, and 7 year of MECAR on appliance and remodeling. So which option is correct? First is from the property side. We all know it's a real property and residential property. So 27.5 year is right. That is something we all know. Now about the appliances, right? So the appliances have a life of 5 years.
Five
So
years.
first, second option and fourth option is, like 50-50 is done. So that is not there. Right? So now you need to choose in first option or third option. So first option says 27.5 year MECAR on both sides. So both sides he will not get. So first option is incorrect, right? He'll get the MECA depreciation only for the site which he has given on rent, because other site is his personal use asset. On personal use asset, there is no depreciation, right? So third option, if you see 27.5 year of MECA on rental side of the property and remodeling, 5 year remodeling is also being part of residential property, right? That is also important thing. 5 year on the appliances, right? Make sense?
Yeah.
Yes, sir.
Next is depletion. So far we have covered depreciation and amortization. Depletion is for natural resources, right? So it is a process whereby owner of economic interest or natural resources may recover the losses of their investment. For example, like oil, gases, mineral, coal, etc. Right? So there are two methods of depletion. One is cost method of depletion, cost depletion method, and the second is percentage depletion method. Right? So in the first, which is cost depletion method, so you need to calculate the cost depletion per unit, right? For example, you have purchased a coal mine or a gold mine or a silver mine or an iron mine or maybe like oil well, right? So what is very important to understand the expected amount of the natural resources in that particular place, right? Then second is to calculate the cost per unit, depletion cost per unit. So how will you calculate? It will be equal to total cost or the adjusted basis divided by estimated number of unit you are expecting to extract, right? So if it is a coal mine, so how many metric ton of the coal of the coal you will be extracting? If it is like oil well, how much oil you are expecting to be extract? So the estimation of unit is very important, and the total cost which you have incurred, including the purchase cost plus, one of you were telling if there is any dismantling charges, right? That also you need to be capitalized at the beginning, right? So the total cost include the purchase cost, installation cost, any other capital improvement, or the dismantling mandatory cost. Divide by number of estimated unit. So that will give you cost per unit. So depletion cost of the period, right? Every year you are charging depreciation or amortization. Same way, every year you need to charge depletion as well. So depletion for the period is equal to number of unit extracted multiplied by cost per unit. Very simple. Clear everyone? Number of
Sir,
unit.
in that case, uh, do you think it's better when the owner purchase and they can make a schedule in advance, that
Mhm.
first year, second year, and number of
Mhm.
lifetime?
Yeah.
What
No
will be
way.
the
Yes,
right?
yeah. Practically, this is how it happened. Like first thing, when you planning to purchase, like any mine or oil well or something, so first you will make a business plan, right? So you involve like engineers who will do, like who will certify it and provide the estimation how much coil or maybe gold or maybe silver or maybe oil you can extract out of this particular mine, right? First of all, the detailed research is being conducted by the group of engineers, and they come up with like based on their best of estimate, right? So then you get to know how much quantity I can expect out of this particular mine. Then second is the cost part, so which you negotiate when you are purchasing on it. And then if there is any dismantling cost and other cost which is being required for installation and other thing, so everything you will be calculating. So calculating the cost. Now coming to once you are done, once you have purchased the assets, once you are ready to go for extraction and all those things, so management will make their budgets also, right? So in budget, they make like each year how much extraction we will be making and how much sales we will be making out of it and how much profit or loss will be generating from this business, right? So any such big business, like the small mom and pop shops may not make like budgets or business plan, but all this big company, first make the business plan, then do the feasibility test, then do the market survey, then do the engineering research, and after that they plan to get into such business because it's very capital intensive business, right? And then
Yes, sir.
accordingly they all make like business plan, and based on that they have some numbers in place how much unit they will be selling, right? Accordingly they make estimation and depletion plans. Make sense?
Yes, sir.
Hmm? So the cost of depletion no longer applicable when the adjusted basis or cost of resources is reduced to zero. For example, at initial, you expected that this mine will give me 1000 metric ton of gold, right? And you have extracted all 1000 metric ton of gold, but still there is more gold available, right? In that case of scenario, you have already recovered all your cost by charging the depletion period over period. Then whatever the extraction you are making is your direct income. Only the expenses you will be charging, but there will not be any depreciation. This is what it means. Make
Okay.
sense? Cost basis must be reduced
Yes, sir.
every year by depletion amount, whether by the cost or percentage method. That means the cost at which you have capitalized every year with the depletion amount, you'll be reducing it. So this is about cost method of depletion. Clear, everyone? Second is percentage depletion method. So as the name suggests, here you'll be estimating how much percentage I'll be extracting, and accordingly you'll be charging the depreciation. So percentage depletion method is lesser of the following two amounts. Flat percentage specified by IRC on gross receipt. So when it is difficult for you and when it is difficult for the engineers which are certified engineer to identify like how much the resources will be there in the respective mine. So the government, the IRC, has also issued the specific rate for specific category of mine. So for coal mine, it is something. For gold mine, lithium mine, silver mine, iron mine, oil wells, there are certain percentages being defined, right? So you can use that percentage straightforward. That is also acceptable as per IRS. Or 50% of the taxable income from the property before taking depletion deduction. So whichever is lower. Either the government rate provided or 50% of the taxable income, whichever is lower. For example, you have made a total sales of $100,000. You have incurred manufacturing cost of $10,000. You have incurred labor cost $20,000. You have incurred overhead cost $30,000, excluding depletion cost, right? So your taxable income before depletion is $100,000 minus 10 minus 20 minus 30, that is $40,000, right? So the depletion will be lower of the following. Let's assume in IRS the defined percentage is 15%. So 15% of the gross receipt specified by IRC, that is $15,000, or 50% of the taxable income without depletion expense, that is 50% of 40,000, which is 20,000. So which one is lower? 15,000, right? So you can consider 15,000 as a depletion under the percentage depletion method. Percentage depletion is not restricted to the cost basis. Here is the key difference. Percentage depletion is not restricted to cost basis. Even though by using the percentage depletion method, your entire cost is recovered, but still after that you can charge depreciation by using the percentage depletion method. Whereas in the cost depletion method, maximum depreciation you can charge is up to the cost of the respective asset. On the percentage depletion method, there is no restriction. Taxpayer can recover through the depletion deduction for more than they have invested in the resources. The excess taken become the tax preference for alternative minimum tax calculation. So that we'll be discussing when we come to the AMT chapter. Some common percentage of depletion are 15% for copper, gold, silver, iron, or oil and gas. 10% on coal and lignite, right? 5% on gravel, peat, sand, and humus, right? So these are certain percentage for the respective category of mine, which has been defined in IRC. Generally, percentage depletion is not available for oil and gas well, and the timbers. So for them, we are using cost method, right? So this is all about,
Sir,
yes,
at
please.
a common percentage depletion, 15% you have written for oil and gas, and a note you have given as
Yeah.
generally percentage depletion is not available for oil and gas.
Yes, yes. So 15% is been given in the oil and gas, but practically we do not use this percent. Rather, we use cost method there. So that is practical experience. Like in oil gas, generally they use cost depletion method, not percentage depletion.
Okay.
Right? Any other question? Okay. So this is about like depletion. Okay. Next is 1230. So next topic is actually slightly bigger. So maybe we can take a halt over here. I would say like go through the notes till page 32. So maybe if some of you are missing the notes, I'll send you this updated one right away so that you can go through this. So today we have covered.
uh, Sir, one question, like we have a, I'm just trying to relate and asking the question from the
Mhm,
Indian standard. We have a uh, different method of calculation for software, either
mhm,
software developed internally or
mhm,
purchased from outside. Because
mhm,
this concept was also there in US.
mhm. Yes. So there are two things. When you are purchasing outside, you can directly capitalize as intangible because you purchase the IP, right? If you're using for SaaS, it is expense, but if you have purchased IP, then yes, it is your intangible cost. When you are internally developing software, so research cost will be expense of, development cost can be capitalized.
Okay, sir.
Right. So we will continue with section 1231 and series of the section, because those are that is like the new topic, new concept, and slightly bigger as well. So in next class we'll be first studying 4 section, and all those 4 sections are very important. The section 1231, which is the bigger umbrella, under which we'll be studying section 1245, 1250, 291. So these 4 sections generally studied together. So I have summarized in the table. So that we'll be studying, right? And I'll send you all these notes so you can go through, so that if you have any question, so first in the next class we can discuss your doubts, and then we can start with the 1231, 1245, 1250, and 291, right? So this is it for today class. So I'm sending you the notes. You can go through that. Okay.
Thank you, sir.
Thank you.